Climate Law Matters, the UK Emissions Trading Scheme. Interview with Dr. Diana Casey. Hello, listener. Welcome back to our podcast, Climate Law Matters, in which we explore the key legal developments across different sectors to address the issue of climate change. I'm Christopher Moss, a barrister at 39 Essex Chambers, specialising in planning and environmental law. In this episode, I'm really excited to be joined by Dr. Diana Casey, Executive Director of Energy and Climate Change at the Mineral Products Association, a board member of the Emissions Trading Group, as well as the chair of their Emissions Trading System Policy Group. Thank you for joining me, Diana.
Thanks, Christopher.
So, could you just start by telling us a bit about your background and your expertise in the area of emissions trading?
Yes, so I first got involved in emissions trading back in 2010 when I joined the Mineral Products Association, or MPA, as a climate change and energy technical advisor. MPA represents a number of different mineral products, but in particular, the energy and carbon intensive cement and lime sectors. When I joined in 2010, the draft legislation for phase 3 of the EU emissions trading scheme was being developed. So I had to very quickly get up to speed with the proposals and the issues that were affecting those sectors in particular. Since then, I've also gone through the development of phase 4 of EU ETS, then phase 1 of UK ETS following Brexit. And currently, there's quite a lot of development going on around the next allocation period of phase 1. Just in terms of my involvement in the emissions trading group, that's kind of been a part of my work since I joined MPA in 2010 as well. And ETG represents the majority of businesses covered by the UK emissions trading system and its predecessor, the EU ETS in the UK. Now, ETG provides a forum for discussion and resolution of all aspects of emissions trading, and it quite uniquely brings industry and government, including the regulators and all the devolved administrations together to really focus on emissions trading and its policy and trying to ensure that it's going to work for everybody. So, yes, it's a very interesting area.
And just to start with the basics, what is the emissions trading scheme and what's it trying to achieve and how really does it work?
Emissions trading is a market instrument designed to encourage emissions reduction at lowest cost. It essentially sets a cap on emissions which reduces over time. So just to unpack that a little bit, the cap is made up of allowances and each allowance equates to 1 tonne of carbon dioxide. Eligible industries in the scheme have to closely monitor their emissions, and then on an annual basis, those emissions are verified by an independent and accredited verifier, and then reported to the relevant environmental regulator, depending on which sort of nation they're situated in the UK. There's then an obligation on them to surrender allowances equal to those verified emissions. Now, the trading or the buying and selling of allowances creates a carbon price. And while industry and power generators who are part of the scheme buy allowances to comply with their obligations in the scheme, there are also traders in the market who buy and sell allowances in kind of a similar way to the buying and selling of shares. So that's sort of a very high level view of how it works. In terms of what it's aiming to achieve, the UK ETS cap is aligned with the UK ambition to achieve net zero by 2050. So the reduction in the cap over time is aligned with that decarbonisation trajectory. And in the near term, it's aligned with the UK nationally determined contribution, which is the UK commitment to decarbonise as part of the UNFCCC process.
What industries are covered by the UK ETS?
It covers all heavy industry, so sectors like cement and lime, as I've mentioned, steel, paper, chemicals, etc. So a lot of heavy industry. It also covers the power generators as well.
Okay, so pretty wide-ranging.
Yes.
As far as large-scale government-run schemes go, the UK ETS hasn't faced that many legal challenges. However, the lawfulness of introducing the UK emissions trading scheme was unsuccessfully challenged in the High Court in 2021. In the case of Elliott Smith against Secretary of State for Business, Energy and Industrial Strategy. The second ground of challenge was that the UK ETS did not fulfil or serve the statutory purpose of the Climate Change Act 2008 of limiting or causing the limitation of activities causing or contributing to greenhouse gas emissions. The High Court rejected this argument, finding that an emissions trading scheme doesn't necessarily have to achieve a reduction in the activities consisting of greenhouse gas emission or causing or contributing to such emissions, and that it's sufficient if the design of the emissions trading scheme limits or encourages the limitation of such activities. Thinking about that second ground, does the UK emissions trading scheme encourage the limitation of activities causing or contributing to greenhouse gas emissions?
So the ETS makes it expensive to emit greenhouse gas emissions, and as such, that extra cost puts pressure on businesses to either change their process to reduce emissions or to reduce the activities creating those emissions to try and mitigate that cost. And as that cap comes down and the number of allowances reduces, the idea is that the cost could go up if you're not reducing your emissions. So there is a clear signal to do that. The challenge is that rather than investing in decarbonisation here in the UK, another option is just to close a business in the UK and reopen it somewhere else overseas where there aren't any requirements to reduce emissions. And the products can then be exported into the UK. So it's still achieving its aim of meeting the UK climate ambitions, but it's not actually helping overall global emission reductions because you're offshoring the industry to countries less able or willing to address them. And then, of course, you've got the emissions associated with transporting products back to the UK as well. And we call that carbon leakage.
I think just picking up on that last point, compliance with the ETS is regulated by national environmental regulators, so the Environment Agency in England, and non-compliance with the scheme can result in sanctions, such as failing to surrender allowances that might lead to the imposition of a civil penalty. In terms of encouraging industries to engage in the UK ETS, is that achieved more by the carrot or the stick?
In terms of engagement in UK ETS, I think the regulators do work closely with sites, with companies, and also with people like myself in trade associations to support those who need to comply as much as possible. There's lots of guidance, there's lots of kind of notifications, so that they do their best to get the information out there before it gets to the point of having to apply penalties because a company hasn't complied. They do work hard to kind of push those updates out. But I think the penalties are there and they are used to ensure compliance. ETS can cost businesses many millions, and avoiding that payment can create competitive distortions, which in our view must be avoided. But the carrot versus stick approach question is quite an interesting one generally, because if you were looking at that in relation to the ETS as a whole, I think, in my view, ETS definitely follows a stick approach. The aim is to kind of pile on costs and make it cost effective to decarbonise. But the challenge is that that approach worked to address the low-hanging fruit of decarbonisation, if we can call it that. So, for example, things like energy efficiency improvements, some fuel switching. When we come to technologies required for deep decarbonisation, so I'm talking about things like hydrogen, or in the case of the cement and lime sectors that I represent, carbon capture, it's not just the sites that need to invest, but a whole value chain. So things like the pipeline that will transport captured CO2 and the storage site, it transports that CO2 too, means that basically that ever-reducing cap and increasing cost with no support to deploy that infrastructure is rendering UK companies uncompetitive and pushing some of them to the point of closure. So that's very much a stick approach in my view.
Now, there's clear financial benefits for the government in terms of the UK ETS, in terms of financial and revenue generation. And the National Audit Office found that in excess of £17 billion had been generated by the auction of carbon allowances. We've obviously heard a lot about the stick, but how is industry incentivised to engage in the scheme in the first place?
I think it's actually up to 19 billion in revenue now. So it is a significant amount of money. You know, I think in some ways industry doesn't have a choice in engaging. The industries that are covered, particularly on the heavy industry side, like cement and lime, they are obligated to comply. And that financial cost means that they have to be engaged and they have to manage that compliance very carefully. We have seen in other sectors, particularly, companies struggle with that compliance. There's the British Steel example where the government had to bail them out. And that was quite a hefty bill. I think it was around about 100 million, if I remember correctly. So, businesses, the cost is the incentivisation, really.
You've mentioned there the UK cement industry. How does the UK ETS work for this sector in particular?
So the UK ETS and its predecessor, the EU ETS, has helped to decarbonise the sector. If we look at the cement and concrete value chain, we've decarbonised 63% since 1990. However, since 2018, we've seen an 18% reduction in production, and imported cement now makes up 32% of the UK market. So that carbon leakage that I mentioned earlier is a real threat to the sector, and that is all as a consequence of uneven carbon pricing between domestic producers and competitors overseas. Now, there are mechanisms in the UK ETS to try and mitigate that carbon leakage. The sector, for example, receives a proportion of the allowances that they have to use to comply with the scheme. They get a proportion of them for free every year, and that then reduces the cost of complying on the sector. However, the proportion of free allowances they receive are reducing, and the rate of that reduction is going faster than the sector's ability to decarbonise because of that reliance on things like carbon capture. And that's one of the reasons we've seen a decline in domestic production in recent years. Just in relation to this, in case it's of interest, we are very supportive of the proposal for a carbon border adjustment mechanism to try and level the carbon cost between domestic producers and importers. And that's going to be really key to continuing to encourage decarbonisation and not just offshoring of industry.
I think that's a really interesting point that you made at the end of the carbon border adjustment mechanism. What would that look like in practice?
So this would be a mechanism where importers will pay a tax essentially on those imports based on the embodied carbon. So it will require importers to kind of ask for information from the producers of that product overseas to gather information on the emissions that are contained in those products. And then a return would have to be made to HMRC and then a tax paid. And the design of the scheme is such that it takes into account that domestic producers get those free allowances. So the carbon cost is essentially equal to what domestic producers pay. And that would just help level that carbon cost playing field.
You also mentioned in the previous question the interaction with carbon capture, utilisation and storage. Now, we looked at this in our last episode of the podcast, didn't look specifically at the interaction with ETS. And could you tell us a little bit more about that?
The overall aim of the ETS and the generation of that carbon price is to help businesses make the case for investment in decarbonisation technologies to mitigate against the increasing carbon cost. The challenge for CCS is that it is quite an expensive technology, and that carbon price has to be considerably higher than it is currently and has been to date to really incentivise that investment in carbon capture. However, the other link between the two, between carbon capture and UK ETS, is that the UK government has recognised that more support is required. And they've developed a business model that makes carbon capture investable in the absence of that high enough carbon price. Now, that business model is based on a contracts for difference type of scheme. The reference price is currently fixed, but in future is expected to be linked to the carbon price generated by UK ETS. And also, for initial projects signing a contract for that business model support, they are required to forfeit their free allocation, essentially so they don't get a sort of double layer of support. So there's also a link between the two there as well.
Picking up on the point of carbon pricing, the National Audit Office in June of this year raised concerns about the effectiveness of the UK ETS being undermined by low carbon pricing. And I think in the UK, at the end of May of this year, the average carbon price stood at £50 per tonne, compared with the EU average of £60 per tonne. And you've already covered some of the impacts, but overall, why does it matter if the price of carbon is set too low?
The main impact is that it doesn't support the deployment of decarbonisation technologies. So it's not achieving its aim, but it's still piling a cost on business, which renders it uncompetitive in international markets. Now, a higher carbon price would only overcome that if it was accompanied by a strong carbon border adjustment mechanism for industries that are very exposed to competition with overseas producers, and also the support to deploy the infrastructure required for that decarbonisation.
I'm going to move on now to talking about evaluating the UK ETS. Now, you've obviously got quite a lot of experience in this sector, including the predecessor to the UK scheme. And I just wondered, how does the UK's scheme differ to the predecessor, the EU emissions trading scheme?
So initially, when the UK split out from the EU, the scheme mirrored the EU scheme almost entirely. There were a couple of changes that were made to make it more applicable to UK producers. In the lime sector, we had a really big problem with the benchmark that's used to determine the number of free allowances that the producers get. It just wasn't fit for a UK sector that didn't have access to some of the fuels that the EU sector had. And the UK government increased that benchmark slightly for us. So that was sort of one, some relatively minor and quite sector-specific differences. But it's the current developments that are really starting to see the two schemes diverge. So the UK extended the current allocation period, as we call it. So when the free allowances are determined, they're kind of set for 5-year blocks. So we had a 5-year block from 2021 to 2025. And then there's another one from 2026 to 2030. And the UK decided to extend the current allocation period to the end of 2026 with a new set of rules expected from 2027. The EU is negotiating new rules now, and they are therefore potentially going to be different. And they've got new benchmarks and new rules for the free allocation coming in at the start of next year. One of the other differences is the scope of the sectors. So the EU is currently setting up what's called ETS 2, and that's going to include things like building, heating and transport emissions. Now, the UK hasn't indicated yet that it's going to cover those sectors itself, but instead it's looking at including things like greenhouse gas removals and also the waste sector. Another difference is related to the cap trajectory. The EU scheme actually reaches a cap of 0 in 2039 to 40. So they've got like huge ambitions for all this sort of hard to abate industry to reach 0 emissions by 2039-40. Now, the UK has consulted on the UK ETS cap and what's going to happen beyond 2030, but we're still waiting to hear the government response on that. So we're not quite sure yet what's going to happen. So there are, a few differences starting to appear.
I understand that earlier this year, the UK and the EU agreed to work towards linking the UK ETS and the EU ETS. Did the divergences that we're starting to see between the schemes make that a more difficult proposition?
I think the challenge with linking is, well, for the UK, the EU is a much greater scheme. So what could happen is that the UK has to take those rules. Now, for businesses in the UK, there's already quite a bit of uncertainty because we're waiting to hear what's going to happen from 2027. Now, we're expecting more information from government, possibly later this month, but by the end of this year. And that's all going to be caveated by it's going to depend on linking. So it's creating quite a lot of uncertainty, and it will make those discussions potentially trickier unless we're willing to adopt, or there can be some agreement that, okay, the rules are slightly different, but the overall ambition of the scheme is the same. And at the moment, it's a bit early to say kind of which way it would go. So yeah, we're going to be watching that quite closely.
And just briefly, in terms of the opportunities of linking, does this intend to try to reduce that carbon offshoring that you discussed earlier?
I'm not sure that it will address that just by linking, because the challenge is also a challenge for the EU plants. And we're seeing, particularly in the cement sector, more imports from North Africa and Turkey that sit just outside that EU boundary and aren't paying a carbon price, and the EU are facing that as well. I think where the opportunities that sort of come to mind for me, the UK ETS market is a fraction of the size of the EU ETS market. And being smaller means it's far more susceptible to price volatility. We saw this in 2021 when it started operating, and the price in the UK went really quite high. It did reach £100 a tonne at one point, and it was much higher than the EU. Now, linking will just help overcome some of that volatility because we'll be part of a much larger market. It will also help align carbon prices with the EU. So there will likely be just a single carbon price covering the UK and the EU, whereas at the moment they are different. And the third opportunity that springs to mind is a mutual exemption on the carbon border adjustment mechanism. So the idea is that the linked schemes trade between the two regions could happen without complying with the carbon border adjustment mechanism, which makes complete sense when, all the businesses are already paying a carbon price. And it will mean that we can put the focus on ensuring that CBAM is watertight for those imports that are coming from outside the EU. So there's definitely a number of opportunities there.
How can we measure the success or otherwise of the UK's own ETS scheme?
So on the face of it, you'd think success could just be seen as looking at the decarbonisation of the industries regulated in ETS. However, as discussed, that decarbonisation could be achieved by offshoring the emissions, which in my view would be a failure of the UK ETS. So I think the measurement requires measurement of the decarbonisation of the industry and ensuring that we haven't just seen a corresponding increase in consumption emissions, so the emissions that are being imported in the goods we consume. And I think that's a really important measure of actually, is ETS driving decarbonisation or deindustrialisation?
And at the moment, is it possible for us to tangibly measure that point, or is that an area where more work is needed?
It's definitely an area being explored. So the Climate Change Committee, they have looked at consumption emissions. And I think there's been some other work done in government as well. I'm not sure it's maybe as accurate as it would need to be to say it's measuring the success of something like UK ETS. So something that definitely needs a bit more work, but it's important that we start looking at those consumption emissions.
And the final question that we ask all of our contributors to the podcast doesn't have to just be within the ETS sphere, but what do you see as the greatest legal or non-legal barrier to addressing climate change?
For me, very simply, I think ultimately it's an uneven global carbon pricing and ambition to decarbonise. Until we're seeing the same effort from everybody, we're going to have these competitive problems that are going to undermine our ability to decarbonise.
Thank you very much for your time this morning, Diana.